we'll move to our topic. Forecast 2024. And,
so I will say, it's great that we have a video. For someone like me, I love stats. and everybody has different perception, but this is a half hour of like crammed in stats. We're not going to go through all of them. We're definitely going to give you the video. I think it's super important, and I'm really happy that a valid source in the California Association of Realtors came out with this so early, because there's so many people sitting on the fence waiting for something.
Yeah.
Typically lower price points, lower interest rates, and man, this video is really good at identifying how they think that's really going to play out all the way into next year. And that just gives people a lot of time to really think about making plans to determine if they're going to make a purchase or not.
All right. Well, let me just get set here. I will go ahead and put this in the comments. This is a public link. And as Darren said, it's 30 minutes long, and there's an even longer report. But certainly check it out if you have interest. I thought it was really good as well. There we go. Okay. All right. Well, let me make this just a little bit bigger.
Yeah, so we're going to play a little bit of it. The longest segment's right in the beginning, about 5 minutes. Then we're going to jump around to a few spots. But again, we'll give you the whole link if you want to follow up with it.
Okay. All right. Well, let's check it out. Here we go.
We're going to give you a little bit of a Cliff Notes version of the full-fledged forecast that we'll be going through tomorrow in all of its gory detail, and just kind of summarize where we're at in the marketplace and the economy and where we see things headed on the basis of kind of current news. Of course, we just had the Fed that met and decided to do nothing. And so we'll talk obviously about interest rates and their impact on the market and where we see that headed. And all of those things. In general, I would say that we're relatively optimistic that things will improve as we move into 2024. And we'll talk a little bit about why and how we're already starting to see some of that materialize in the marketplace right now. First and foremost, I think it's important to point out that even with all of the uncertainty, with the challenges, with the higher interest rates that we've seen, and even though we've seen sales that have dipped over the course of the last couple of months, we still haven't seen sales fall to the low levels that we hit last winter. Now, when you look at pending sales and where interest rates are, I think it's possible that we won't have that V-shaped recovery and that sales will remain relatively tepid over the next couple of months. But I do think that low water mark of 235,000 that we hit at the end of last year is probably the lowest we'll see things go. And again, we actually have rebounded at least a little bit from those very depressed levels that we were at towards the end of last year. The other thing I think that is important to point out is we don't see a big uptick in inventory from distressed sales. So there's a lot of reasons why the fundamentals in the mortgage market look a lot different now than they did back in 2008. And I think first and foremost amongst those is the fact that people are still paying their mortgages on time. And we know that there's a lot of folks that are locked into the lowest interest rates of all time. If you look at all of the underwriting criteria, FICO scores have been very high for the last decade. Vast majority of people are coming into the market with money down, with documented incomes, with fixed rate mortgages. So their payments are pretty much set in stone. And of course, most of these folks are still paying their mortgages on time. So the most recent data we have through June shows less than 2.5% of mortgages in California are currently delinquent, meaning that 98% roughly are being paid on time. And of course, you don't throw your keys back to the bank or foreclose on a home that you're current on the payment on. The other data point that I think is relevant is that the vast majority of homeowners out there actually still have home equity, both as a percentage of homeowners and actually the value of that equity. And I think that's another strike against a major surge in distressed sales, because again, not only are you making those mortgage payments on time, even if you get into trouble economically, financially, what have you, you're in a position for the most part to be able to sell that home on the open market without taking a big loss or needing the bank to come and take over that home with an NOD or something like that. Now, I think this is good from a fundamental standpoint, right? We're not going to have a bunch of distress, plummeting home prices and things like that, but I think it will also be one of those things that just means inventory is going to stay that much tighter as we move forward. And of course, I think that's probably the limiting factor when you think about the housing outlook for next year is not that rates are high, but rather even at the fairly lackluster level of housing demand, we still don't have enough homes to put those, that smaller number of buyers into. And I think that's going to be the thing that makes the recovery relatively slow. One of the things that we're already seeing in the marketplace is that sales are low, but prices are trending up, which also kind of implicates supply as being that limiting factor. If it was all housing demand that was driving the show and rates that were scaring buyers off of the market, you'd see sales that were down and prices that were also down. But if you look at this chart, you can see the prices have pretty much been trending up for the entirety of the year, at least on a month-to-month basis. We didn't get back to those all-time high price levels that we hit last year. So up until the last couple of months, we were still negative year to year. But over the last 2 months, we've actually seen prices that were even up relative to those high levels of last year. So we both had a strong seasonal bounce in home prices this year and actually have now clawed our way back to those levels that we were at when rates initially started to go up last summer and last fall. And we're currently at a roughly $860,000 median price. And again, I think this suggests that it's not demand that's the problem right now, even though there's certainly just a mathematical reality that buyers don't qualify for the same amount of home as they did last year, and some folks have been priced out of the market. Again, this is still suggestive of too much demand relative to very, very limited levels of supply. Now, this is obviously something I think that's good for homeowners and people who are prospective home buyers who maybe have been waiting around for prices to go down or the foreclosure crisis to see that, waiting has only resulted in both higher prices being paid at even higher interest rates. And I think that is something that we can.
All right.
Yeah.
Some comments on that.
So much packed data here. Gosh, if you're in the, I want to put this on our website with a link, man. It's just really, really good. I don't, he said it. I don't even know that I need to comment on it. I'm just going to fill some other, really said it well, clearly stated. I'm going to discuss some other things between that and the next little segment we're going to jump to before we open up that next segment. So, broad economic outlook is strong, wages growing, people are spending, inflation is still a little bit of a concern, housing affordability is just below 20%. We're nowhere near where we were low teens back in 05, 06, and 07. So we're not in that range yet. It's important to compare that. But because we're still seeing such a strong economy, as I started by saying earlier, the importance of looking at this so early, so far in advance, is that they think they're going to prolong. And he talks about and shows charts about data because the Fed publicizes their predictions for future Fed funds rate. And they've moved those up. We're now at 5.5% Fed funds rate. They were predicting 4.5%, at least a 1% drop by next year. And their last meeting, they moved that up a half point. Which means they're dragging out these higher rates because of the strong economy, because they're afraid inflation is going to come back. Higher wages equal higher prices consistently. They talked about the labor market being such a relevant component of inflation. And I think we're all feeling that if we're going out into the world and spending money anywhere, everything is more expensive. And we always talk about, particularly around construction and housing, it's product, because product relates to labor, but just labor straight up has just grown exponentially so much. Economy next year, slower, maybe a tinge of a recession concern, but most likely slower. They talk about 1% growth next year. we'll see what happens. We're at a 2.4 month supply of inventory. Super low. Strong seller side market still.
You know what surprised me when he said the average house is like 860,000 across California. That blew me away.
Statewide, sure. I mean, it's such a big state, and there's varying ranges. There's like, this is such a good video. All right. And he talked about something that we talk about. Here's one thing: 60% of homeowners have 4% or less on their interest rate. So they're disincentivized to sell, and we've brought these things up, but they're there. He summarizes them well. They're disincentivized to sell because they'll get a higher rate. A rate needs to come in that's a little closer, from maybe 4 to 6, 4 to 5.5. Some of those people, they might step up and sell and go buy something else. They're also disincentivized because of capital gains. There's it's the highest rate of 14% of owners are above the threshold capital gains. That means 14% of owners are above 250, and in many cases 500,000 in profit they would get out of their house. And so a combination of rates and the potential of paying taxes on the capital gains. People are also staying in their house much longer. We talk about this, and it was just the normal language for us for a long time. The estimated time. People get a 30-year mortgage, but they're in their house for 7 years, right? Maybe you should consider a shorter rate. But now, for the sales this year, the estimated time in the house is 12. That's the highest it's been in a long time, or as long as they've been tracking it. I don't remember exactly which one, but 12 is the first time I've heard that number. Wow. So let's jump into that next segment then.
I have to say, so far, we do this every week, tracking the market, and it sounds like we're pretty right on. So that made me
think. Yes, we are. We're not off here. No,
not at all. Yeah. All right. Let's go into the next here.
Move into that's available for sale, and you see this kind of reflected in this all-time high for folks that have stayed put in their homes longer than ever before. And I think this is leading to a market that, although you have buyers that are waiting for the good deals, it's actually becoming more and more challenging. Again, prices are rising, inventory is very low. Even at 7% interest rates, the typical home last month, or at least the median transaction, went pending in less than 3 weeks. So homes are still selling very quickly. We still see the market very, very competitive. We have almost half the transactions last month closed above list price. And so again, kind of illustrating just how even at this relatively low level of housing demand, it's still far in excess of sales. That being said, I'm optimistic for our members because I think consumers really need us. Even with the market as competitive as it is and many homes selling above list, we've also seen about 30 or a third of active listings that have had to do some form of price reduction. So it's a market environment that really necessitates expertise to navigate, because on the one hand, prices are rising, inventory's low, but sellers aren't as firmly in the driver's seat as maybe they were when rates were at 3%. The other thing I think it is important to point out is that there's a lot of nuance to the market. You have a lot of buyers that have been.
Is that enough on that one?
Yeah, that was great. I do think it was important just to get the perspective of the overall dynamics and what's triggering it. First-time home buyers, more stats. First-time home buyers, 36% of the market. That was interesting. All cash sales have risen tremendously. Almost 28% of sales are all cash. Certainly, we have identified that houses that have potential, particularly even need more work to get up there, that market has not been as active. And that's because combination of interest rates and then lack of experience, if you're an owner occupant, of getting that house up to par, has created opportunities for house flippers to come in and buy those with cash. And they're getting it, they're not paying 7%. Some of them are paying with hard money, which is in the 10% plus range. but it's still for a short term. 27, that's the other one that really got me. They showed a chart of new homes coming online, right? With talking about lack of supply and a lack of inventory. There's a chart in there that is showing cities in California. Oh my God, I think we're 50 times higher than any other city in California. In Los Angeles, we have 27,000 ADU construction projects going on. Huge number. And that's really how they're adding a lot of houses these days. They didn't give the number of apartments online, but that's a lot. And there's no other city on the chart they showed that even came close to that.
Right.
Wow. Population came down in California, and this is also relative to availability. In 2023, they're saying, and they expect it to be flat next year. They do expect it to level. So maybe we can go ahead and jump to the next one now. In the 27 minutes. There you go. You got it.
Let me try to open this up. Hold on. Oh no, I think that's all I got. Okay. This is what you wanted, right? Just this page.
Yep. Yeah. That has the stats. That is the official forecast and percentage of where they expect things to land. So on this page, drop in volume of 22% is what they're predicting will end 2023 with. Lower volume, 22% down. And in 2024, they expect a 22% rise in volume.
Right.
So we'll come back on volume next year. Affordability, they're predicting, is going to come down a few more percentage points to the 17% range, which obviously means prices are going to go up. A predicted price increase in 2024 over 2023 of 6.2%. And in the end, as he said in that first segment, we went on a decline in the middle of last year, which ran into early this year, but we're going to ultimately be flat or slightly above to finish out this year compared to last year even though we went through a period of a dip, we've been on a rise. And their expectation is the year will end with a 6% interest rate range. And that's definitely going to be determined based on where inflation goes and how the Fed adapts to that.
Yeah.
So stacked with data, but man, I mean, buying a house is just, you have to have somewhere to live, but it's good to know what to expect. See a little vision into the future to help you make a decision.